Hi, of late there's been a lot of question about what are the factors or inputs that cause interest rates to change. Before we look at that question in great detail, let's think about what interest rates are. Interest rates are the price of money. And prices of all kinds of things, they go up and down all the time. The price of gold goes up and down, the price of silver goes up and down, the price of stock goes up and down, the price of baseball players and hockey players goes up and down in free agency from year to year. So there's no reason the price of houses goes up in general, and sometimes comes down too. So there's no reason why the price of money shouldn't follow the same demand and supply situation. Bigger demand, bigger supply, price goes up, price goes down. Now, usually the price of money doesn't change that much on a regular basis, because like most other things, it doesn't change all that much, like other commodities, coffee, bananas, soybeans, orange juice, whatever. But sometimes the price of money changes dramatically. Now, the central bank's job is to affect or control the price of money so that it works beneficially for the overall economy. When things are bad, generally speaking, the central bank injects money into the economy, raising the supply and making interest rates fall, and the cost of money gets cheaper. When economic conditions are really good, people say, I don't want so much money. The Federal Reserve takes money out of the system, causing interest rates to rise. So generally, economic conditions are what drives the behavior, and the central bank tries to either follow those tendencies or lead them, as the case may be. But sometimes we get very, very dramatic price changes in a relatively short period of time. And what happens here is either expectations of the future get affected through some event, or there's actually something that happens that actually changes expectations completely dramatically a lot. So in the first case, for example, we might have an election. An election changes expectations of the future. A new president, a new policies, new taxes, new this, new that, different this, something changes. We think things will change. It could affect the value of the dollar and affect interest rates and the cost of money. Conversely, if once we hear, for example, an injection comes out, wow, that's really good news. That's going to lead to higher economic growth. If economic growth is better, I don't want to hold money. I want to sell bonds and do other stuff. In that process, we drive the cost of money up. I hope this has helped make sense of what interest rates are and how they work.